Hello everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much you taking a little bit of time here to check in and to hear some of our thoughts about where we see things. It's been a pretty exciting couple of weeks, including up to and including the time of this recording. So to be respectful of your time, I'm going to get right into it and talk about what we're seeing out there. Last couple of weeks, not very appealing. It really hasn't been. We had a hot start in January. We really cooled off here in the later parts of February and beginning into March now. Actually, 4 out of the last 5 weeks, as measured by the S&P 500 index, have been negative. And we talked about that a little bit in our last update, how we are expecting this year, as much as I would have liked for January just to be a real takeoff point and to be, a blissful kind of bounce back sort of occasion. We talked about it being a washing machine. We talked about some big ups and some big downs, and we're starting to see that here. So we're anticipating that washing machine is going to continue, that we're going to have some big ups and some big downs, but we're not really going to establish new highs or new lows. We're going to kind of keep in this range, and at least to this point, that certainly has been the case. We expect that that's going to continue. One of the major reasons why we expect that's going to continue is because of what we heard from the Federal Reserve this week. Jay Powell gave his testimony before the Senate Banking Committee and the House Finance Committees this week to give his thoughts on where he sees things and also to respond to questions from members of those committees. I won't get into all the gory details. Hopefully you didn't spend so much time watching it like I did to hear what he had to say directly. But really what we heard, which was most important for the kinds of things that we watch on your behalf, is that the Federal Reserve Board of Governors doesn't have any intention of stopping their interest rate increases anytime soon. We had talked about in previous updates how we thought maybe the first quarter of this year would be the time when they would start to slow down and perhaps even stop with their interest rate increases. Because of the data points that they see that they're watching closely, which I'll talk about here in a few moments, they're not seeing the kind of data response that they would like. And so there's going to continue to be interest rate increases over where we are today. I expect at this point, at least through the second quarter, which would be the June meeting. So it would be interesting to see in what size those are going to be. A lot of debate about whether it's going to be 25 basis points or 50 basis points, or also known as 1/4 of a point or a half a point at their next meeting. Really, really hard to know at this point, but it's probably going to be one of those two, either 25 basis points or 50 basis points again. Right now, the futures contracts are indicating it'll probably be 25 basis points, but that can change. So why is the Federal Reserve wanting to continue to raise rates? Well, some of the primary markers that they use to measure inflation, even though inflation continues to come down off of a high of over 9% in the summer of last year, our last print here a couple of weeks ago was just a breath above 6%. It isn't responding as fast as they would like, and so they believe that there needs to continue to be additional increases in order to temper inflation. Two primary reasons why inflation is tending to be stubbornly high at this point. One is we still have an ultra-tight labor market, and I do use that adjective of ultra-tight in looking at where things are right now, because when we look at it historically, generally speaking, unemployment should be in the 5 to 6% range, relatively speaking, sometimes even closer to 7, depending upon other factors. We're below 4% right now. As a matter of fact, as of this morning, as of the time of this recording, about 3.6, 3.7% on the unemployment rate. That is ultra tight. And so that's keeping wages high because it's hard for employers to find workers. They're needing to keep wages higher and higher than normal in order to attract other employees. And because of that, that tends to lead to wage inflation, which is a component of overall CPI. Second big item that we're seeing as well is that real estate, and it does tend to be a slower indicator or a slower reacting indicator, also is at still a very significant level, both on the sales side of things and in terms of the rental market. And so because of those factors, again, we're seeing inflation. Those are two big factors when it comes to calculating CPI, or the Consumer Price Index, which is the most common marker for measuring inflation. Because of that, that's why we're continuing to see inflation at a high level. So the Federal Reserve is still very focused on wanting to temper that to a lower level. They've said that their mark point or their target is 2%. between you, me, and the lamppost, I'm not sure that we can get there in this kind of environment, but they definitely want it to be below 6 or a little over 6, which is what we have right now. So they're going to continue on this path of raising rates. So what does that mean as far as the overall markets are concerned? Well, you heard me say, I continue to expect we're going to be in a washing machine, kind of like we saw in January, February, and now into the early parts of March. January was good, February not so good, March really not all that great to this point. But we're pretty much back to the space of where we were at the end of last year, especially as measured by our most popular indices. You'll see that a lot of them are relatively flat for the year now, coming down from where they were, but relatively flat from where they were to start the year. We expect that kind of movement to continue because the market really has a tough time in pricing stocks, pricing bonds, while interest rates are so much in flux. And while the target rate, or sometimes you'll hear it on the news, the terminal rate, is something that really is unknown at this point, meaning when is the Federal Reserve going to stop raising rates in this cycle? So because so many algorithms include the 10-year Treasury, the benchmark 10-year Treasury as part of their pricing model, we really don't know where that's going to end at this point. And certainly some of the things that were expected even a couple of months ago now are not expected much at all. And so that continues to be very much a moving target, and that's why the stock market is kind of moving around like a washing machine at this point. So we're going to continue to watch that. Our expectations are quite muted, if you will, and you know that from listening to our most recent updates here in terms of what we expect for the balance of this year. We really need to get beyond this raising cycle in order to feel confident in what we can expect for coming next. I'm going to shift gears a little bit and talk just for a few moments on some news items which came through this week, which definitely are impacting a part of the market, not the overall market as such as we're seeing it at this point, but definitely causing some headlines. You may or may not have seen anything about it, and it's understandable if not. It's the kind of things that we watch very closely here. But in the last couple of weeks, and then up to and including today being the second instance, we've had two instances where we've had banks move to a space of bankruptcy or really a takeover by the FDIC, or the Federal Deposit Insurance Corporation, the federal agency which steps in whenever banks get into trouble. A couple of days ago, we had Silvergate. Silvergate was a very niche bank, and it really focused on cryptocurrency, or those kinds of things, which were those entities involved with cryptocurrency. So a very niche kind of bank. They got into some trouble with some of their holdings as far as the valuations were concerned. They had a run on assets. They needed to liquefy some of those assets in order to meet demands from depositors to make withdrawals, and they got into a pretty ugly space. So that was just a couple of days ago, and then as of the time of this recording, literally it's happening in real time right now, we had Silicon Valley Bank, or SVB. Silicon Valley Bank, also trading publicly as SVB Financial, literally closed their doors in terms of doing business because of, again, a run on assets where a number of very large depositors wanted to make withdrawals because of some concerns about liquidity, and they simply weren't able to meet demand immediately. So literally, as of this afternoon, as of the time of this recording, the FDIC stepped in and essentially has taken over, and they're going to open up here on Monday. This being Friday, they're going to open up on Monday and going to be able to meet the insured needs of the depositors up to $250,000 per depositor. Well, as you can probably imagine, and this is true for Silicon Valley Bank, especially because of the kind of, again, niche business that they deal with a lot of private equity and Silicon Valley companies. So they have some very, very large depositors out there who are concerned about the liquidity of their assets. And that has affected the market. We tend to think in straight lines when it comes to the market, not we individually, but now I'm speaking to the overall marketplace. Tends to think in straight lines, and because of what happened with Silvergate and now what is happening with Silicon Valley Bank, there's some concern about banks right now. And so we've talked with a number of experts in this field literally today because just the value of experience. We have a lot of connectivity to folks who watch regional and large money center banks very, very closely. And we asked them some pretty probing questions, which I'm sure they only got about 10,000 times today as far as folks asking them. But I asked them some pretty probing questions about what they see, and should we be concerned about something that's called contagion, or is this something that would seep very quickly into other parts of the financial universe? The bottom line, folks, and I trust these folks with whom I spoke very deeply and have had very long-term relationships with them. Bottom line, folks, is I have zero concern at this point. I don't see the kinds of things that would give us pause or large level concern about our financial system or about the ability for our large money center banks to continue to do business. These two banks happen to be very focused, very niche, in dealing with some higher risk industries. And whether you're talking about cryptocurrency or talking about private equity or startup companies, those tend to be pretty niche, pretty high risk, high reward possibilities, but also higher risk. And they happen to have been in some pretty unique circumstances and situations which have caused them to move to this space. So because that's true, and because of other circumstances that we watch very, very closely throughout our currency and monetary system, I don't have any concern at this point about other banks or that other banks are going to follow suit. Certainly we watch it closely. Certainly we give a lot of attention to it. It's been heightened here over the last several days as we've watched these events unfold, but nothing at this point that would indicate that we need to have larger concern about the overall financial system. But like I said, I continue to watch that. We continue to watch it here to make sure that we're not missing anything, and also that we're not just blinded by our desire for things to turn out well. We seek with great intensity to watch things as they are, not necessarily as we want them to be. So we'll continue to watch it. I'll continue to update you, but at this point, no concern about contagion or about the larger liquidity issues inside of our financial system. So I wanted to bring that to you. I wanted you to hear from me directly. If you watch business news, you may have seen these kinds of things. I know the New York Times has picked up now and done their distribution. I expect the Associated Press and other large international news outlets are going to pick up on this news story as well. So I wanted you to hear from me directly as those events are literally happening in real time around us here. Well, friends, I want to be respectful of your time always, and so I like to give you pertinent information, but then I also like to get out of your way relative to your time and your space. Thank you so much for your willingness to indulge me here as we share a little bit about the things that we're seeing. Always, always, always feel free to reach out to us. You have questions, thoughts, you have concerns, things you'd like to review. I'm always happy to do that. Always happy to share where we see things. And if there are things that you think we need to approach differently, always happy to hear that as well. But again, it's always good to hear from you, whether via email or a call, or in this day and age on video through Zoom or other means. Always enjoy hearing from you. So please always feel free to do that. Well, friends, again, I appreciate so much your time. Thank you for it. And until the next time, I'll look forward to chatting with you soon.